Dean Baker joins us from the Center for Economic Policy Research. Dean, I just got to bring up your op-ed here. You've been vicious with your quill recently. Let's bring it up here. Bring up the Baker op-ed. This is just vicious. This route of economic stimulus, through government cutbacks can at best get us close to where we were before the layoffs. It is not a way to add jobs to the economy. And you go on to say wages won't move. This is the key economic theory. Wages are sticky. What does that mean right now for the Tea Party?
Well, in principle, the story that, if they work it through is that they're hoping we're going to reduce demand coming from the government, reduce employment in the government, put downward pressure on wages, and that will lead to more hiring. And it's just very, very hard to tell that story. The evidence really doesn't support that. I mean, if we get enough unemployment, I don't mean to say if we get 20% unemployment, we won't eventually start to see wages drop. But that's a very perverse way to try and get the economy back on its footing.
The point, whatever your philosophical background, folks, this point that Dr. Baker brings up of wages being sticky, whether you're Dean Baker or John Taylor, this gets in the way of simple economic thought. It's a little more complex. What is not complex is our confidence. Baker considers a less confident America, the consumer confidence numbers out of Michigan today. Dean, we're so far away from where we were pre-crisis. What is your policy prescription to get us to a greater confidence?
Well, I mean, there's a few different routes. I mean, unfortunately, all seem difficult politically. I mean, we could spend more stimulus. That's not likely in the current Congress. Bernanke, the Fed, could be more aggressive. Again, we have kind of a political stalemate there. They're basically shutting down their QE2 program, and for the moment, at least, it doesn't look like there's going to be a QE3. You could try to get the dollar down. Again, that's something that doesn't have impact immediately, a big issue with our trading partners. I think actually the best route is going the other way. If we can't get the economy to grow, the best thing we could do is redistribute employment. And the model here is Germany with their work sharing, where they've actually managed to get a reduction in their unemployment rate. Their unemployment rate today is lower than it was before the start of the downturn, and that's even though they've had no more growth in the United States.
Are you supporting, Dean, the idea that we should force Americans to work fewer hours?
Well, you aren't forcing. You'd be giving incentives. Basically, what we do now is we give incentives for employers to lay people off because there's unemployment insurance. Well, instead of having that be a 0-1 proposition, you get unemployment benefits if you're laid off. You make that, you say, well, how about you work 20% fewer hours and you get 10% less pay? That's the sort of model you have in Germany. So it's not a question of forcing. It's just how you get the incentives right.
Here's a chart. When does labor catch up? This is one of the big issues for 2011, folks. Corporate profits so large, capital doing well, labor struggling. There's the real average hourly earnings adjusted by the Cleveland CPI, and you could see we've rolled over. Dean, critically, was the good labor wage growth of the 90s an aberration, or do we just assume we should be able to get back to that?
Well, I think we can get back to that if we get back down to low levels of unemployment. The key here is we got the unemployment rate down to 4% as a year-round average in 2000, and that was the first time we really saw robust wage growth, 97 to 2000, since the early 70s. So I think the key here is get the unemployment rate down to low levels again. That doesn't sound very promising right now, but that's what we have to do to ensure that workers get their share of the pie.
Dean, do you look at it as an aggregate economy, or have you parsed it out into two groups, those educated, those in the game, those employed, and we've got a structural America that's greatly struggling?
Well, clearly you do have some people who are still doing reasonably well, and it does tend to be those with the most education. But I should point out that seems to be a very small group at this point in time. So there's this idea that we need to get people to have better education, which, of course, think is a good thing. But that's clearly not the main problem in the economy. So you still have people with college degrees, people coming out just out of college that either can't get jobs or very often are getting jobs that don't require a college education. So it's clearly not just an issue of lacking skills, lacking education. As much as it's good policy to improve the skills and education of our workforce, that's not the big problem in the economy today.
Dean, I got an email from an obvious conservative the other day who said, look, you talk about this tax, tax B, tax C, tax D. All they know is when you sum up all the taxes, we're paying a high burden, whether it's property tax, or AMT for the haves, whatever. Should we look at our all-in bundled taxes, or would you suggest we should look at an individual tax analysis?
Well, I mean, in a certain sense, you want to look at both, but I'd say in terms of the all-in bundled tax burden, it's the lowest it's been in decades because we've cut a lot of taxes recently. And in terms of, how you assess them, I mean, we do get more for our taxes in some respects. Obviously, some of the big taxes that most people pay are their payroll taxes, and you get more in Social Security, more in Medicare benefits for the simple reason people are living longer. So it shouldn't be surprising that you're supporting a longer retirement, you're going to pay more in those taxes.
Chart 5, bring it up here, if you would. I want to look at this chart here. Our balance sheet, we showed this the other day. Dean, it's a long-term view. Our average balance sheet, household net worth divided by disposable personal income, and we're essentially back to the 50s. I mean, we're just like we're average. Was the wealth feeling that we had in the 90s, in the middle part of the last decade through housing, was that an anomaly? Or can we manage ourselves back to a high net worth versus our income?
Well, I think we can get back there, but this is why allowing the stock bubble to grow in the 90s and the housing bubble to grow in the last decade were such disastrous policies, and it should have been possible for Greenspan and other policymakers to recognize that at the time. They seem to think this is all just great, and sure, the bubbles might burst, and we'll just turn around and recover from that. That's not the way it works, and that's why we have the picture you have today. We have a whole huge baby boom cohort that's at retirement or just a few years from it, and they have almost nothing saved. They're entirely dependent on their Social Security and Medicare to get through their retirement. So we can get back there, but that's going to be a long, hard road, and we've really been down the wrong path.
Dean, thank you so much. Dean Baker, Center for Economic Policy Research. Look for his blog out on the internet.